Welcome dear traders. Today I would like to do a little reaction video. There are not many traders out there whom I follow, but one I've been looking at over the years now and then is TraderNick. So recently I found some of his newer videos. He trades mostly on higher time frames, which is great. He spends a lot of time on fundamental analysis. I think these days he's more concentrated on the stock indices and metals and oil. Not so much on single forex pairs, as far as I can see, but I always liked his vibe. I always liked his approach, and he seems to do very well. So I would like to react on this particular video he posted a few days ago. Let's go.
So today on Twitter,
and I will put the link to the original video in the description.
I got called out. Specifically, I got called out by Matt L. or Matt Leach, who runs Lark Funding, which is a prop firm. And we're going to discuss a little bit of what he had to say. As we get into this video, if you enjoy this sort of commentary, if you enjoy these conversations, make sure to hit the thumbs up button and subscribe. Let's jump in. Okay, so yesterday I put out this post about my trading results, just basically 2024 and an update on my performance, and I actually got some interesting comments on this. And I just want to say off the bat, disclaimer, Matt and I are cool. We are not, beefing at all, but his comment was actually a very good question that I imagine other people who look at my content may have also wondered. So what Matt did is he pointed out that, love the transparency, Nick, 11% return is very impressive. Genuine question though, that's 12.5% less than just buying the S&P 500 this year. What's the argument for continuing to trade this account and not just put the capital into the market? Which is a very valid question. Why the heck are you trading when you could just passively buy and hold the S&P 500? And Matt asked this question, and I know that he means this genuine question again.
Okay, so the trade performance looks very good. So you see you made over 1% here, then over 2%, 185, almost 2.5, almost 2, flat, slightly down. So this is a good performance. I mean, no doubt about it, especially for bigger accounts, yeah. And this whole argument, well, you can just buy and hold the S&P. I mean, this is very, very short-term thinking, because people like that don't understand that the stock market can turn and go down. It can also go flat over several years, okay? So the stock market is very high right now anyway, so it's not, a very, very strong argument to say, oh, why are you trading actively? You may as well just buy the S&P and hold it. This is a very naive argument, but let's continue.
Been cool for some time, and I think we're on the same page with most things in the trading world. Slow and steady, consistency, no get rich quick. This is a lot of hard work. We're on the same page. But this was a great question, and I wanted to discuss. So I actually answered it, and we're going to go through the answer right now. So I actually tagged back Matt's question. He said, love the transparency, as you just saw. And I responded to it, and because this is really important that we make this distinction. In fact, I'm glad that Matt brought this question up, because it really helps to add some context here. So great question. This year for me has been good, but not exceptional in terms of percentage gain. And if you watch my channel, I've been talking about this. Like, it's been a good year for me. I've made money this year in the markets, but it's not an exceptional one. Last year was exceptional. Last year in 2023, I had a rock star year. I think it was about a 30% gain year for me. It was a beast mode year, and it was awesome.
Yeah, not every year is the same, right? Some years are great, some years are mediocre, some years are even bad. That's valid for any trader you look at. Yeah, if you look at the world's most popular hedge fund managers, investors, traders, that applies to all of them, okay? The vast majority of them has a down year. I think James Simmons doesn't have a down year, and I think Stanley Druckenmiller neither had one, but only because of a certain calculation thingy which went on. But of course, I mean, like, everybody knows that not every year is the same. Some are strong because your strategy or approach had very favorable conditions. If markets are more tricky, your performance may go down. So that's very normal.
This year, still good, but not nearly as good. And as Matt points out, that is actually correct. I've underperformed the S&P 500 this year, but outperformed in the last 4.5. So we'll talk about that in just a second, but I just want to talk a little bit about the index, and then we'll come back to this. Now here's a look at the S&P.
So, outperforming the S&P over 4.5 years is very good. That puts him in a very small group at the top, okay? So, since inception, up 188%. That's a great average performance per year, So, come on, it's not bad at all.
This. Now here's a look at the S&P 500 over the last few years, and what you can see here is that it is just a one shot to the upside here, especially this year. You can see if we zoom in.
Driven by big tech, ladies and gentlemen, yeah? The big tech companies, they're going up and pulling up the indices. It's not that all stocks across the board went up, as many of you know, by the way.
Like, it has just actually been a cookie cutter example of an up year. In fact, I believe that this year, as we are recording this right now, is on pace to be one of the best year performances for the S&P 500 in decades. Like, it is topping the charts. As we look at the S&P 500, currently year to date, let's see where we are. If we go over here, I'm going to find right January, right around here. I mean, if you're talking about this is January 1st or so, you're talking about a 23% up year, just holding on to the index. Now, here is where things get really tricky. I'm not gonna lie, it's hard to justify. Why am I trading when I can just put all my money in this thing, hold on to it, and then I'm up massively? Here's where the problem arises, and although Matt has made a really good point, he also completely agrees with me with the point that I'm about to make.
Spoiler alert.
This is an incredibly uncommon outlier year for the S&P 500. Do you know what the long-term average for the S&P 500 is? It's around 9%. In fact, 9% is generous. That's considering a lot of the last 20 years, which has been a straight up market and very low interest rate.
Like very long term, it's more around 7% per year on average.
Now, if you look at the very long-term performance for the S&P 500, considering, you also have times like 2008, 2000, where you lose a couple years and gains are just down the toilet. But this last 20 years or so has been some of the most exceptional stock market performance that we've seen in many decades. Now, if you go back in time, there are periods like this where there's a sideways year. If you go...
Okay, this is a great point. When I started out as a stockbroker, it's around, this kind of market phase. I mean, markets were consolidating. They were literally going up and down and not going anywhere over years, Only after, and it's not the last 20 years, it's more like the last 12, 13 years, we had a bull market which went far above the average bullish cycle, which is driven by a tech revolution and... Oh, sorry, what am I doing? But this is a great point, and people do not do historic analysis, and they think this is how it is, and this is how it's going to stay. But who says that it's going to stay like that, you see?
Been so impressive, right? You just sat there and watched it go sideways, up and down and up and down.
That's right.
So there are times where we can look at the index and say, this is just foolish to be trading when we could just passively invest. But then look at this. If you had bought this market from all this time, in 4,700 days or so, you made 2%. So
this is a very, very valid point. And thinking about it now, it's not even that we necessarily need to get into a massive stock market crash, but he's right. Even now, at some point after this tech boom, there could be a consolidation where a lot of things are consolidating on the macro scale, even technologies, which translates into company returns and all of these things. Emerging markets maybe, consolidating. So, and demand going down there. So there's many, many factors involved, and it's quite feasible that we're gonna be in a different phase soon. In fact, statistically speaking, it's very likely with each quarter passing. So this is a valid point, and people who especially young people these days, they seem to assume that stocks always go up. Well, once the phase is over, they will understand how this game actually works,
This is my point, is basically there are times when stocks just go straight up and they look like the holy grail investment. And then there are times where stocks actually look horribly silly to be waiting around for.
Yeah.
And can you imagine, just think for a second, imagine if you parked all of your money hoping to get some sort of return, and after 10 years, you were flat, meaning you hadn't made or hadn't lost anything. The reason I bring that up is because although that doesn't feel like it's possible in today's era, it totally is.
It's absolutely possible, for sure. Also, stocks are a great inflation hedge. We had a lot of inflation in the last years with markets overheating. Now we see the first signs of also that changing. So, of course, it's absolutely thinkable. Yeah. One thing is for sure, in markets, nothing stays the same forever. I can assure you that.
Everybody thinks this time is different when it comes to the stock market and that it won't have crash periods and big down decades. It's entirely possible that we see something like what happened in Japan, which was a lost decade. They lost, for an entire year of sideways market, or go back to the 2000 to 2008 era where we saw, a sideways move. I'm not saying...
Yeah, I mean, these things are possible. Yeah, we have many big social changes happening. Like structural things happening in terms of, society as a whole. Yeah, there's so many factors. You could start at the very ground level. Yeah, less and less people are getting married. Less and less people have kids. We see populations actually going down in many countries. We had the living cost crisis phase. Education is getting more and more expensive. Jobs are getting more difficult to get. The national debt is increasing. The trade between countries can enter a new phase of change. So there's so many factors where everything's changing. Of course, artificial intelligence, remote working, new technologies, a replacement of human manual jobs by robots and AI, and I could go on and on and on and on. Yeah, the economy moving towards a service-based digital economy. Yeah, with less and less physical products. So there are so many factors which change society, change the economy. That after such a big jump in asset prices over years and years, of course, things also can slow down and everything can be reevaluated. Yeah, no question about it. The big money was already made now. So now comes the dangerous phase where the question is, okay, correction, sideways, and all of these things. Historically speaking, that seems to be the more likely scenario. Things to watch regarding these questions is, for example, earning numbers of big tech companies like Apple, Tesla, Microsoft, Amazon, Google, etc. Yeah, how are they doing? What is the actual outlook? What is their cash flow? What's their profitability? And all these kind of factors. But no question about it. Like the statistics are clear, and stock prices can definitely change. It's also not impossible to have a multi-year bear market. Yeah. That's also a possibility, and the people will then try to buy the dip and all of these things. So I like the way he approaches this. This is exactly how I do it. I really like this coming to the point. Not waffling around, condensing a lot of information into simple facts. Beautiful. That's why I like his style of working. It's a pity he doesn't know about the market causality. That would improve his trading a lot as well. Please let him know that we're here. Anyways, let's continue.
That's what I think is going to happen. But we as traders don't have the luxury of hindsight in our favor, right? So we have to trade with what we've got. So back to the conversation here with Matt. Let's go ahead and switch over to this view again. So here's what I said back. I said, notably, however, the S&P 500 is also trending well above its historical average returns in the last few years.
That's right.
That being said, I just wanted to also add, I did share that my personal performance during inception to now, I compared it to the S&P 500 just to give some numbers. I'm up 188% on this account compared to the S&P 500, which is up about 144% since the time my account started trading on it. So the reason I say this is because very specifically, I have been able to outperform, but it's not like it's by a country mile. It's not like a ginormous outperformance.
Okay.
We're talking about 188% compared to 144%. But again, you are talking about the last few years have been just absolutely exceptional outlier returns for the S&P 500.
Okay, so he is an active trader. Okay, he takes long and short positions in the major markets. First of all, it's great that he beat the market. Of course, the stock market just went up and up and up in the last years. Okay, most hedge funds got out of business and couldn't even keep up with their performance. So it's great that he at least was beating the S&P. That's already an achievement. I agree 100%. And that the outperformance is not by much is of course because of the reality as we looked at that the markets just, especially last year, just continued to go straight up with very little pullbacks. Now this is not how it's going to be every year. So this, if he continues to perform well, his outperformance should increase as well. So wow, I like this really open approach. Well done, Nick.
500 passive investing. So during the last few years, people who have been passively investing look like heroes. But there are also periods of time where, again, we just saw some examples where the market just goes nowhere.
Yes.
And those people are left with no returns. So the S&P 500 is also trending well above its historical average returns in the last few years. I believe it's a dangerous assumption to continue expecting it to produce 13% a year or
I agree.
Like it has done in recent times.
100%.
Again, if you're someone new to the markets, you may have only ever seen stock markets just go straight up. And the reality is, and the dangerous reality is, that suckers people into thinking, oh, stocks just go up every day. And when they finally do not, people lose everything. So a lot of people will go, full margin, long,
Yes.
high risk assets. Like they'll just go super long NASDAQ and when it maybe even apply leverage or borrow money in order to go long. And then when that changes, it can really hurt people. It's been quite difficult to beat the index when the market is going straight up, but it is still possible to do. So I've beaten it in a period that has been very difficult to outperform the index, and I am proud of that. I've been working incredibly hard to get to this point in my trading career, but it's not like I'm beating it massively. That being said,
he seems to be very disappointed about that. Well, don't worry. In the next years, your outperformance will increase, I'm sure, if you continue to do well. This is the nature of the stock market game. Look at all the big investors, Ray Dalio, Tudor Jones, and all this. Yeah, it's always something like that.
This is a very, worthwhile. That 44% extra is significant in the course of 4 or 4.5 years. And it does really help to compound accounts. Any extra that you can make over the S&P 500, is good. It's very difficult to do, and I don't claim to be.
Well, you will do brilliantly if you had the access to the MK web, Nick, because there, this would be the perfect, the missing piece to your approach, to be honest, in my opinion, because you would understand when the scenarios where the fundamentals are in one direction and the markets go completely in the other. When you look at the MK web, you see there's a squeeze of dumb money, and you will understand that. And after a while, you can even trade that. So again, my suggestion is, look at the MK web.
Greatest trader of history, but certainly I'm proud to have been able to outperform in this period. In fact, even if I had underperformed, I'd still be fine because I'm not going to try and just beat the index when it's in an up year or up period. I'm trying to beat the index over the long term when it has very corrective periods, down years, etc. My goal is to still somehow produce some sort of alpha or return beyond what the S&P 500 passive investing looks like. That's the whole point we're trading, right? We want to earn something more than just passive income or passive investment returns, which are quite good historically speaking. But again, making that assumption that we're going to get the same kind of returns going forward is a dangerous one. So let's keep going. So while 44% more than passive investing may not sound exceptional, over time this sort of outperformance could help to compound an account well. Matt responds back, he said, Nick, this is why you're the man. A 4.5-year track record is insane. I agree this year for the S&P 500 has been an outlier. Love the transparency and your argument makes total sense. Yeah, so Matt and I are on the same page, but it was a great question. It's really important that we think about these things and discuss them. So also I added something else. My account is actually up 13.4% this year, which is still well under the index of 23 or whatever we said. So definitely underperforming this year. I'm not going to try and say otherwise. But, I'm still up this year. I'm still having a good year overall. I've been trading a lot of gold this year, trading, index stuff. I've been doing option stuff. So I've been a little bit spread out. But in hindsight, I said this next. I said it certainly has been. In hindsight, I would have piled everything into the NASDAQ and then just took a vacation. What am I doing all this work for? But important
That's
question.
not how this works, as he says himself. Yeah, I mean, would have, could have, should have. If people would have known that Bitcoin would go to 60k, they would have not sold at 6k. That is hindsight for sure. And as he says, you shouldn't feel bad because over several years the difference will come out. But of course, I mean, traders like to have a very good year. But for that to happen, also things need to align. And in his case, with a focus on indices and the big markets on higher time frames, it is like he says.
Is also asking how traders can navigate a change in market environment when it inevitably happens. So at some point it's going to change, right? At some point you're going to get sideways years, down years. You're not just going to have years that go up and up and up and up. That being said, I do believe in stocks for the long term, buying good companies at great value and trading in the direction of the upside predominantly. But making the assumption that we're just going to get banger returns every year is going to be crazy, right? Because if you think about it, if we're seeing 23%, what's the average again? Like 9%? So if you're going to have an average 9% for the S&P 500, you're going to have years that are negative to balance out those 23% years. So just something to think about. If the markets produce another sideways decade, which is actually quite common through US history, we showed some charts earlier, ideally traders would be able to still produce some sort of consistent profit. And this is where the edge for traders potentially is if the market goes sideways, traders can still make money. You can still spot trends that are existing on lower time frames, still make money during that time. And I do think that during this time, passive investors would see no gains. I mean, they definitely would. If you just held the S&P 500 and it went slightly negative for 10 years, even the dividends that you collect wouldn't offset the passive sideways move. Anyways.
Yeah, I mean, it doesn't even need to be like 10 years. I mean, of course, it's also possible. But what about a 4 or 5 years consolidation, where things go up and down, but overall didn't really reach a new big level? Yeah, I mean, looking at the overall markets in 2024, end of the year, yeah, for sure that can happen. And it's also predictable that many people will just buy as soon as markets come down. And yeah, sure, there are also dividends and all of that, but as he rightfully says, I mean, these are just facts, traders. I mean, in the stock market game, the numbers of average returns and all that, there's a lot of data for a long period of time, and of course things change fundamentally as well. I mean, companies have changed in terms of their advancement. The factory used to produce certain amount of physical goods. Now we have for example, internet-based company, providing services. So the economy has changed a lot in structural terms and fundamental terms, for sure. But the market dynamic can definitely repeat. There's no question. And these are the market phases where active traders and also hedge funds will outperform the index for that period. Okay, so interestingly, the last years with the market just going up has been tough for stock hedge funds because they had pressure to beat that, against people who just bought and hold. That's not supposed to mean that it will stay like that for another decade. I don't think so.
I ended it with this. I think traders, dividend investors, option sellers, and dollar cost averaging could seriously outperform at some point. I mean, the question here is timing. When is this going to change? And to that answer, I have no idea, right? When something really changes and we see a catalyst that's dramatic, 2008 was a big catalyst that really changed things for several years. 2000, you had the tech bubble. I don't see some sort of impending massive bear market, but I also don't think it's reasonable to expect the same kinds of returns that we've seen in recent years. Despite looking silly compared to buy and hold in recent years, I do think that these things, option selling, dollar cost averaging, dividend investing, traders, of course, active positioning.
I mean, option selling is a very dangerous business. You should only sell options on underlying if you have the underlying. Yeah, if you own a stock, you sell option on it, that's okay. But never sell naked options. Okay, then you're picking up pennies in front of the steamroller, and eventually you will blow up. Look at Victor Niederhofer. Okay, just as a footnote here.
Could have its day in the sun again. It's been an interesting few years. You know, another stat that's been interesting is like how many hedge funds have underperformed the S&P 500 in the last 15 years. It's a wasteland out there if you're trying to find traders and hedge funds that have massively outperformed, because again, the S&P 500 has just gone straight up. It's very hard to beat the index when it is just going up. But again, that will change. Great traders will be able to survive, stomach, and even make money in different market environments when things do change from this long-term risk-on cycle that we've been in into perhaps a more risk-off, value-centric cycle. And I'm sure that if you are watching my channel and, knock on wood, I'm still around, we will see some of those environments together. If you're a long-term person who's been watching my channel, we will certainly see them together. We'll navigate them together. And, hopefully we don't lose our shirts. Anyways.
Why would you lose your shirt? Because you seem to be really disciplined and you have good risk management. You stops and everything. You don't over leverage. So I don't think you will use your shirt. You may have a bad phase or drawdown, but then you will come back from that. I mean, look, just to take a perspective also in terms of Forex versus this stuff here. Foreign exchange, if you're a good Forex trader, you can manage a small fund successfully with an active strategy, yeah. 20, 30, 40 million. But then if you would trade billions as a Forex trader and exclusively in Forex, you would really need to change your strategy. And I can tell you right now how, because we know how. You would literally need to limit yourself to trading the squeezes, yeah, from the market causality. Because your positions would be too big to, do quick buys and sells, and even trades towards MTS, you would get detected at some point and get hunted. You understand? So Forex, of course, the returns can be higher, but the scalability is overall lower. Yeah, there are big billions of dollars stock hedge funds, long short equity, macro funds. There are no billion of dollars FX funds around anymore, as I've explained in another video when we looked at FX concepts. Check it out, by the way, it's a good one, with John Taylor. You see, so this is basically the reality, and nobody tells you these things. They don't want you to understand these things. And people also wrongly assume that just because Forex is the biggest market in the world in terms of market cap and all that, that the scalability would be highest. That's not really the case, okay? The scalability in terms of a buy-side trader is not unlimited in Forex. But you could definitely trade big accounts as long as you only limit yourself to certain setups by basically placing yourself on the other side of the DM as soon as there's a big money accumulation. This is a criteria, just as a footnote here. Okay, so I really like this video. Nick is a cool guy. Follow him. Hopefully he gets aware of our work as well one day. Then he can focus more on Forex, I hope. Because literally for him that would be the missing piece. He could literally take his elaborate fundamental analysis and then just look as a check. Okay, wait a second. Where's the money? Should I enter now? Should I wait a week? That would massively improve his trades, I'm sure. But anyways, that's a cool video, Nick. I appreciate it. Lots of love. Take care. I hope you guys liked it. Bye.